Geopolitical tensions have hit new levels over the past week. Israel's military is telling 1 million residents in Gaza City to evacuate south in the next 24 hours ahead of an expected ground assault in retaliation against Hamas. Authorities around the world are also on high alert today after calls from Hamas for a day of rage. Meanwhile, the Ukraine-Russia war rages on. Moscow pummeling eastern Ukraine for the fourth straight day in its biggest offensive in 7 months.
The global supply chain had largely returned to a pre-pandemic normal in recent months, but growing divisions and splintering alliances now threaten to further shake up global trade and spark sharp fluctuations in commodities. To dive deeper into this, we want to bring in Jillian Tett, chair of the editorial board and editor-at-large, U.S. of the Financial Times. Jillian, it's great to see you here. So there's a lot to unpack of what we're talking about, this global conflict and exactly what that is going to mean for supply chains. Just first give us more of an overview of what investors, what business leaders are considering right now, given the recent escalation that we've seen in the Middle East.
Well, during the last few years, amid the whole COVID crisis, the first question on investors' mind was supply chains actually working or not? Because people wanted to know whether the goods were actually flowing along the supply chains and how much of a disruption and how much impact that it had on prices. But now the focus has really shifted to something else, which is that as the US-China relationship has worsened, there's been rising pressure on Western companies, particularly, but not exclusively in America, to source their goods from somewhere other than China. Now, initially, many Western companies thought, well, that's going to be too hard to do. We're not going to move too fast. But one of the things that the Russian invasion of Ukraine did was to really impress on everyone how quickly geopolitical schisms can suddenly flare up dramatically and force companies to make some really difficult choices. So what we have seen in the last couple of years is growing signs that actually Western companies have been reorientating their supply chains away from China. But up until now, it's been incredibly hard to tell just how significant that shift has been, and also whether they are essentially reshoring, as the White House has often said they should be doing, or friendshoring, or whether they're actually going through third-party countries like Vietnam and others to basically keep sourcing their goods from China, but in a more subtle way. So I've just written a column looking at that, drawing on a host of new research, both from the IMF, which is meeting this week, but also from groups like the Bank for International Settlements that have been tracking these patterns, these incredibly opaque and mysterious flows. The BIS has been using financial data to try and see what's actually going on.
Jillian, is there any clarity around how this could further impact inflation?
Well, I'm in the camp of those who think this is very inflationary, because if you dig down to some of the details of what the Bank for International Settlements research shows, and it's really the first type of bit of research that's trying to track what company statements are saying about their behavior. What you see is that companies have been essentially stopping the kind of one-step supply chain patterns we saw a decade ago, where they bought directly from China. What they're doing now is they are increasingly going through intermediaries in third countries like Vietnam and other Southeast Asian countries, or sometimes Mexico. And what that essentially does is insert a whole new number of new suppliers and new parts of the supply chain, making it ironically much longer and more complex. And one thing we know from everywhere in the business world, whether it's in medicine or finance or manufacturing, the more suppliers you put into a chain, the more cogs you have in that machine, if you like, the greater the chance of higher prices. Short supply chains are more efficient and they keep prices down. That's exactly why Western companies went to China in the first place. So I do think this is very inflationary. It may also be pretty bad for growth as well, because if you begin to see really serious rupture between different political blocs in the global system, you're going to see essentially more and more supply chains being disrupted, and that's bad for activity overall. In fact, the IMF reckons that if you saw a really serious schism between Russia, China versus the West, you could be knocking 7 percentage points off global growth going forward.
Julian, when it comes to some of the things that business leaders are keeping in mind right now, when you talk about the complexity of the supply chain and the reshuffling that we're starting to see, how much does that then reduce transparency, and what is the trickle-down effect from that?
Well, that's a very interesting question because there's been real pressure on Western companies in the last couple of years to essentially track their supply chains and make sure they are adhering to environmental and social standards. So you've seen lots of companies like, say, Walmart or Nestle really working incredibly hard to see what's happening further back along their supply chain and increase the standards there. But of course, it's pretty hard to do that if you've only got one or two steps in your supply chain. When you have multiple steps going through countries that traditionally have been quite opaque, and you're using lots of small and medium-sized companies and people that are essentially operating as intermediaries, it becomes much, much harder to see what's actually happening. So, ironically, if you remember that the whole direction of Western business, the type of thing you'd be taught if you went to Harvard Business School in the 1990s and the noughties was to make your supply chains lean and mean, one step, take out the intermediaries so you get more transparency, more efficiency. If you remember all that, then what you can see is essentially what's happening right now is that in some cases, companies are going into reverse. Now, it's possible this will give them more resilience. It's possible that they're learning to not just rely on one step supply chains from China, but it's also possible that, as I said, we're going to see more inflation, more opacity, and potentially more complexity. And at the end of the day, many Western companies are still actually exposed to China because if something goes wrong at one end of this chain, it will ricochet through.
Jillian, when we think about the state of kind of not just global conflict, but some of the geopolitical tensions that have come to head and come to this point, what does that do in terms of making sure that even in an environment where we've seen so much deglobalization, that there is a pathway forward for reglobalization or recreating ties and perhaps removing some of, not just tariffs, but some of the other headwinds that have kept countries from doing cross-border business?
Well, here's the thing. I think that almost every CEO on the planet right now is wishing that these terrible geopolitical pressures and strife would end and that all this fracture and polarization and protectionism would somehow magically disappear. Jamie Dimon put it very well just now when he said that essentially, these are some of the most dangerous times that he's ever seen, that we've ever seen for the global economy, for anyone doing business. And of course, the human cost of what's happening right now in places like Israel and the Gaza Strip and also in Ukraine is absolutely sky high. It's appalling what's happening. Tragically, it's very hard to believe we're going to see any sudden return to the full globalized spirit we saw before anytime soon. We're dealing with a world of growing localization, or what Morgan Stanley calls growing not globalization but slowbalization. Slowing down of all kinds of trading patterns. That's tragic. The one thing that is encouraging, though, and which may possibly provide some compensation, is the growth of digital links and the fact you are still seeing connections around the world very tight on the internet. You're seeing the rise of things like 3D printing, and you're beginning to see people using the internet to find ways around some of the more negative fracturing that's occurring in the system.
Things that we will continue to track. Jillian Tett, always great to hear from you, chair of the editorial board and editor at large U.S. of the Financial Times. Thanks, Jillian.